Hi, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And this is the second video in a series of demo videos that I'm producing to try to help subscribers and even prospective subscribers understand how to tap into the unbelievable power that the FastGraphs Fundamentals Analyzer software tool provides. One of the comments that I've heard quite often since I've been dealing with FastGraphs is the idea that it's a backward-looking tool and not really a good forward-looking tool. And I think nothing could be further from the truth. So this particular demo video is really going to be all about how to utilize and understand and think about the forecasting capabilities that FastGraphs offers. Now, it starts with a historical graph, and I've purposely chosen Apple here because it allows me to show you a couple of things about this tool. Number one is we always default to our longest term graph, which goes back approximately 20 years. That's all the data that we have available. But the tool itself is dynamic. So if I look at this graph, I'm looking at Apple here. I want you to notice, first of all, that the company's historical growth rate has been 25.01%. That's measuring growth from the beginning of this graph all the way out to include this forecasting data. And for those of you not familiar with FastGraphs, the light green shaded area and the broken orange and blue lines and white line indicate the future or forecasts. The historical graph is the backward-looking part of FastGraphs for sure, but it's also more than that. It's also a very dynamic tool. So, for example, I want you to notice that if the growth rate is 25%, if I look at the bottom of the graph, we list the growth from each year to the next. And if you look at 2019, which ends in September, because Apple has a September fiscal year, growth was 0%, literally. There was no growth that year. And then there was only 4% earnings growth for 2020, which is an estimate, of course, and then 19% in 11. So that growth rate does not add up, obviously, to 25%. So if I shorten the tool dramatically here, now you get a totally different perspective. Now you're seeing growth of 9.95%. But again, I'm going back here to 2013. If I changed it again, I would get a different growth rate. I'm back up to 12.27%. So part of using the tool is running it through different time frames because the tool is automatically calculating growth rates, and growth rates have a very important functionality in understanding or being able to evaluate whether you should be buying, selling, or holding a stock. But we have these forecasting graphs here. So you utilize the historical graph with the forecasting, but you got to be careful with that because you need to analyze and basically understand what you're looking at. This is a long-term graph. The stock looks almost reasonably valued here, or just even a slightly overvalued. It would even look undervalued here at this bottom. But again, when I shorten the graph, all of a sudden this bottom looks dramatically overvalued as well as that top because we're dealing with a significantly different growth rate here. So now let's go into the forecasting tool and actually show you some of the features that our various forecasting calculators have to offer. Now, one thing I want to say, and I say this to all subscribers when I talk to them, the only thing I can say with certainty about the forecasting calculators here is that they're wrong. They're forecasts. They're estimates of the future. Now, the idea is that they're not completely wrong, but they're just not perfectly accurate. So you always got to think of forecasting as kind of a range of forecasts, but you also got to recognize, as I say over and over and over again, those of you who follow me and followed my work know that I'm an absolute advocate of the notion that it's a market of stocks, not a stock market, which simply means every individual stock needs to be evaluated, measured, and researched on its own merits and not in the context of a quote-unquote general market, which is really an illusion in the first place. So bottom line is, when I'm looking at Apple going forward here, we have these forecasting calculators. We have the estimate calculator, which will create estimates based on the orange line on the graph. The orange line is a valuation reference line that's drawn on our historical graphs that basically are utilizing a formula that is widely accepted for valuing a business. So they're theoretically an attempt to give you an intrinsic value calculation. The blue line, the normal PE ratio line, is a best fit line. It's a line that literally tries to figure out how the market has most commonly valued a stock, and it's a trimmed number. One high and one low are thrown out. But the point is, it's not that those lines should dictate to you. You should use them as an evaluation reference. In other words, as I look at the graph here, I'm looking at a PE of 16 and a PE of 15. Obviously, when the price is touching the blue line, that's a 16 PE. When it touches the orange line, that's a 15 PE. Now, I don't take the position that's absolutely what the fair value is. I'm simply using this and I'm studying it and analyzing it. And obviously, the PEs were much lower here when the price was below both lines, and it was higher here. And of course, it's higher right now. We're dealing with a blended PE of 26.4, which is significantly above both of those. Now, when looking at a 12% growth rate here, when I go into the forecasting calculator, based on the consensus estimates. Now let's talk about how these calculators are drawn. In the case of Apple, it's a very widely followed company. There are 38 analysts that are forecasting an earnings. We're using the median consensus estimate. And these 38 analysts are forecasting $12.36 for fiscal year 2020, which ends in a few months, ends in about, another quarter in September of this year. And then for 2021, which ends in September, there are 37 analysts. Now I want you to first of all notice you've lost one analyst. You've got to analyze the data that you're looking at when you're using any research tool, in my opinion, and certainly FastGraphs. But then as we get further out, we get down to 16 analysts, and we actually get an estimate for 2023, but there's only 2 analysts, which in my opinion start to become an opinion. But the point is, this brown graph, this estimate graph, is based on the orange line calculation valuation reference line that you see on the historical graph. And what it's saying is it's also based on the growth rate, which is the average of these numbers that I'm pointing to here with my mouse, the forecast numbers, 4% for this year, 19, 11, and 10, and we get a 10.83% growth rate out of that, okay? And so that's very important because that's how fast the earnings are going to grow, and that's what's going to turn a theoretical $12 and change of earnings into almost $18 of earnings by 2023. But the further out you go, you need to also be simply cognizant of the fact that you're getting data that's going to be less reliable than the closer estimates. The estimates coming up here are probably pretty good. Now, we also give you a historical look because these estimates are changing all the time. Analysts are always updating their estimates. So 6 months ago, they were forecasting $13.10 for Apple. Today, that's down to $12.36. 3 months ago, it was $13.55. It actually had gone up in that period of time. And then the most recent estimate was $12.30. And now we're looking at the absolute most current estimate. The one that's been updated most recently is back up to $12.36. And you can play that game with all these different estimates. So you're also getting an idea of whether analysts are getting more optimistic or less optimistic. Okay, now this is very, very important because these are specific estimates for each of these earnings years, and then we're using a valuation reference of the orange line. The only thing different about the blue forecasting calculator, the normal multiple calculator, is how we draw the fair valuation reference line. We're using exactly the same estimates coming from exactly the same analysts and the same number of analysts. So these two graphs have the same data. What's different is the valuation reference. Now here, this is defaulting to the 5-year normal PE ratio, which is 16.20. So this blue line is a PE of 16. Going back here, this was a PE of 15. You always got to check this fast facts box to make sure you know what you're looking at when you're using this tool. So now we're simply saying this is a little more generous number, the valuation multiple on there. But there's another very, very important and strong feature about this particular normal PE calculator. Those numbers, as I showed you in the intro here to this video, you can see how the normal PE number changed as I drew different time frames. This allows you to look at all that historical data. Now, this in its own right is a very powerful analytical tool. Number one, it shows you what has been happening to the PE. So in other words, 18, 19, 17 years ago, Apple was comfortably trading in the 20 PE range, even as high as 25 times earnings. And then it kind of fell to the 19, 17, 16, and then stayed in the 15, 16 range for several years. And then it's been averaging 18-ish for the last several years, and the 5-year PE again is the 16.20, which the graph is drawn with. But if you feel more comfortable that Apple might be worth, let's say, the 18 or 19 multiple, you can simply go here and pick it. I'll pick the 1-year 18.9, and by clicking on that, I want you to notice that now I've changed that so that I've got an 18.9 PE ratio multiple being drawn here, and I can do my valuation calculations. These calculators are just that. They're calculators. Once you've established a calculator that you're comfortable with, then you can simply point to future periods of time and a pop-up will come up with a calculation of what your return potential would be based on capital appreciation plus potential dividend income. And when the stock is overvalued, like Apple is now, theoretically, if it reverted to the mean and traded at an 18.9 PE ratio, and if it earned exactly this amount of money, that's what your rate of return would be. That's not necessarily predicting what it will be. It's allowing you to calculate out what it would be based on these various variables. But the beauty of it is, and I say this all the time, if I'm buying a stock, I want to have some idea of what I believe the return potential that stock offers me can be. I don't just buy it and hope it goes up or hope I do well. And this allows you to do that calculator. Now, I also want you to notice something else. In both of these estimate calculators, you've got two orange lines, light colored orange lines above the dark one and two below it. This creates what I call the valuation corridor. And again, this goes back to the notion that I know these graphs are wrong. I just hope they're reasonably correct. And I'm going to talk more about that in a few moments. But don't forget, when you're going to the normal PE calculator, that you've got this drop down that allows you to see how the market has historically been valuing the company. And you can pick one that's more aggressive or more conservative, depending on how you feel about the company. See, I can go ahead and draw this at a 15 PE ratio if I want to. So this is a tool, and like any tool, it's going to be as valuable to the user as the skill that the user has in using it. So you've got these two specific year estimates. You'll go out sometimes up to 3 years. Sometimes you won't get any estimates. Sometimes you only get 1 or 2 years. It depends on how widely followed and how popular. Obviously, Apple's a very popular stock. Now, we do have a second estimate package, if you will, that's included in these calculators, and that's the 3 to 5 year trendline growth rate. That's the light brown colored graph. Now, what that does is that simply just gives you a long-term trendline estimate. It does not have specific numbers. Every earnings estimate that's made on this graph is calculated at exactly, you'll see here, the same 13% number in this example. It's actually 12.79. It's just rounded on the table here to 13. Now, that's important because, like, for example, I'm going to go into an external source here. I'm going to go into Yahoo estimates on Apple, and they provide the same data. They've got 38 for 2020 for the year. They have 30 analysts for the quarter, etc. So it's slightly different set of analysts, slightly different set of group. But the point is, it's going to be comparable. And at the very bottom here, they also give a next 5 year per annum data. Now, their number is 11.48. The analysts reporting to FactSet are saying it's 12.79, and there are 5 analysts in this universe offering this trend line. It's a different estimate. It's not the same data. It's just simply a longer term estimate. Now, when I use this calculator, I don't consider it as strong as these first two because we've got near term and specific estimates, but I'm going to be looking out here to kind of see what's my long term potential and see out here, if Apple were to revert to the mean and sell at a 15 PE, it would only give me a 4% rate of return. If it traded at that 18 or 19 PE or even that 20 PE, I might make 8.7%. So these are just what-if calculations. Again, this is a calculator, but I'm only really looking out here when I'm utilizing this tool. So you've got two different sets of estimates here. These two graphs use the same estimate data. This third graph uses a different, which is a trend line estimate, which is more of a long-term estimate, almost always associated with fewer analysts in the universe, by the way, whether it's looking at the Yahoo numbers I showed you earlier or getting the data from FactSet. Then the fourth calculator we offer is a different estimator. It's kind of based on the Ben Graham theory that Ben used to like to measure the company's last 5 years of earnings growth and then calculate the average of that and then use that as a forecaster. Now, with this calculator, you've got that same potential. You've got a drop-down window here that calculates the earnings growth rate for all these different time frames. And as you can see, back, say 12 years, 10 years ago, a decade ago, Apple was a very fast-growing company. And, I've just plotted that in here. I've added the 29.7% growth. If I go way back 15 or 16 years, it was growing at 40 and 50%. So you could utilize those numbers, but common sense would tell you that odds of Apple, already $1 trillion plus in market cap company, is simply not going to be able to grow at those kind of rates. Now, if I look at near term, you're starting to see some single digit growth. So here I've plugged in the 9.48, which is the 7-year historical growth rate. I want you to notice that it's actually started growing a little faster again. And again, we're expecting 12-ish%, 11 to 12% for the 3 to 5 year. So we might want to pick a number like that and use that as simply kind of our go-to number, then try to run our calculation. Now, the fifth forecasting calculator is simply a custom calculator. You can plug in your own dividends, you can plug in your own earnings, you can plug in your own growth rate. You can also, by clicking this little box here, actually combine this trendline growth rate with these specific earnings growth rate numbers. And you can see that I did that here. If I take it off, watch the orange line change by going back to the 3 to 5 year. So I can combine the two. I can click estimates, and now I've combined the estimates, and then I start growing it at the 13%. Once I get past whatever the specific estimates calculator, I can go back to the trend line. But I can also plug in my own number. Here we've got a PE essentially of 15. I'm looking at a growth rate of 12.7%. If I wanted to plug in a 20% growth rate, I could also do that by just simply plugging it in. And again, you can play with this more, but you can put in your own dividends, your own growth rates, etc. So those are the forecasting calculators, the 5 different calculators and how they work with fast graphs. And again, the only thing certain about the future is it's uncertain. They're calculators, they're tools that you can utilize, but they're forward-looking tools based on either consensus estimates or historical growth rates. Now, having said what I just said, the next part of this calculator tool that I want you to focus on is the Analyst Scorecard. You get a nice summary of the scorecard down here where it shows how accurate analysts have been when they made a 1-year forecast, or the forecast 1 year in advance, and how accurate when they made a 2-year. And you access that by clicking the tab up here that says Analyst Scorecard. Now, I want to be very clear about what this is showing you. This is showing you, I've got the 1-year box checked here. This is saying how accurate have analysts been when they made the estimate for 2009, 1 year prior to the fiscal year end. For the 2010, it was how accurate they made the estimate 1 year precisely prior to 2010, and so on and so forth. And then we also give you the 2-year estimate. So this is saying in 2007, when they made an estimate for the 2-year forecast, which you see on these forecasting calculators here, that's going out to the 2nd year forecast. How accurate have the analysts actually been? And the point is, we do summarize this, but I want to make a point. Because we can't hold these analysts to perfection, people want to do that, but they're human beings and things change. You look at what happened, at the beginning of this year. You just don't get perfect clarity on what the future is. So we do give them a 10% margin of error for the 1-year forecast, on the idea that the closer the estimate is, the more accurate it should be. And then we give them a 20% margin of error for the 2-year. Now, in Apple's case, they missed estimates 27% of the time. They hit them perfectly, which is the gold color, 36% of the time, within that margin of error. And then they beat them, the estimates. They did better than what the consensus was, 36% of the time. Now, obviously, it looks like they were better at the 2-year forecast, but keep in mind, you have a much larger margin of error here when you're doing the 2-year, so you'll see that quite commonly. But the point is, you can go in there and then see it granularly and see, how much they missed it by. Like in 2013, on the 1-year forecast, at the end of 2012, beginning of 2013, fiscal year that is, analysts were forecasting $7.59. Apple earned $5.68 when they finally reported. They missed it by $1.91, and that was a 33.6% miss. And then, of course, when they beat it in 2015, analysts were forecasting $7.10, and then they came in at $9.22. They beat it by $2 or 23%, and so on and so forth. And this just tells you how many analysts there were, and and this also shows it as a range here. So it just gives you some granularity. The Analyst Scorecard is very, very good. Now, if I put in a company like Johnson & Johnson here, which has historically a very easy company to analyze, I want you to notice, and we'll just not go into detail, they've had virtually a perfect score on both the 1-year and the 2-year forecast. In other words, that doesn't mean it was absolutely perfect. I'm saying it was perfect within these margins of error that I've been showing you. And you can see that clearly here. It's within the perfect score. Now, if you get a company that's very difficult to analyze, you're going to see a different record. Let's take a look at U.S. Steel. You can see their earnings have been all over the place. They have these periods where coming into the Great Recession, their earnings were screaming to the top. Then they went into negative earnings growth, and obviously it's very, very difficult. So when you see the analyst scorecard for U.S. Steel, analysts miss the estimates 64% of the time on the 1 year, 73% of the 2 year. So if I'm looking at the actual forecasting calculator, I might not put too much credence when I'm looking at U.S. Steel, but if I'm looking at Johnson & Johnson, which has literally had almost a perfect scorecard, I would put some credibility on what these estimates might be and therefore feel like I could rely on the future calculations looking at Johnson & Johnson. And of course, you would apply that. Again, it's a market of stocks, not a stock market individually. I want to end this by simply saying this. Fast graphs do provide a tremendous opportunity for forecasting, and they give you the opportunity to have what I would call reasonable expectations. Now, they need to be constantly monitored because estimates are constantly changing. As you can see that right here in the data where, 6 months ago they were forecasting 912 for J&J as an example, and now it's down to 771. Okay, and you can see it was 987 for 2021, and we're now down to 906. So the estimates are changing, and you want to watch that. We're updating data literally every day, and any changes in estimates that are being reported to FactSet will get picked up by FastGraph. So it's going to be as current as it can possibly be for you. But you still have to monitor what you're looking at, especially if you're doing portfolios. So anyway, this is the forecasting tools or aspect of FastGraph. Remember, it starts with forecasts on the historical graph, but you got to make sure you understand what those forecasts are, and you do that by just clicking the tab, and you're going to see what the growth rate future is. It may be more or less than what the historical growth rate has been. But then when you're in here, you're dealing with the actual forecast, and you can use it for the orange line, what I call intrinsic value calculation. You can look at it for the normal multiple. And I'm going to show you that by looking at a classic example, Ecolab, which is a company that historically traded at a high multiple. So, this even applies to what the first demo that I did, how to use the forecasting graphs. You don't really pay too much attention to the orange line here. I think you should theoretically, but in reality, the market has always valued this at something in the mid-20s PE ratio. So when I'm using the forecasting tool here, I'm going to tend to want to use the normal PE more than I want to use the orange line or the estimates graph. So, every company has to be analyzed on its own merits. Anyway, these are the forecasting calculators for fast graphs. Again, it's a tool. Use it wisely. It can help you dramatically. Always run your calculations out. And remember, on the normal multiple, you've got this drop down, which is a great analytical tool. And if you want to use historical growth as your forecasting tool instead of analysts, you've also got the opportunity to evaluate that. Anyway, thanks for watching. By the way, if you like this video and this demo, go ahead and hit the subscribe button. Give me a like and ring the bell for me. I would appreciate it. It's been a pleasure. The next demo will be coming up on fun graphs.